Hello and welcome to the first quarter of 2020 financial results review for Ferrovial. These are unprecedented times. I'm recording this for the first time on a remote location. That's my basement, and hopefully we won't have technological glitches affecting us. The quarter started above our expectations, and really COVID-19 has impacted during the second half of March. Traffic was ahead of expectations, but in the second half of March, we ended with drops in traffic in toll roads around 70%, and in airports, more than 90% drop of traffic at the end. Construction and services, there was limited impact from COVID, probably only Spain is worth mentioning. And regarding cash generation, it was ahead of our expectations. We ended with a net cash position above the close of 2019, north of 1.6 billion euros. And this enables us to have a strong liquidity, 5.9 billion euros of liquidity. We take into account the undrawn lines. And this is a good situation to be it for opportunities or uncertainties that could come along. Regarding the COVID-19 per se, the company has been engaging mostly with the services division in maintenance of hospitals, operation of ambulances. We have provided breathers, masks, and also the company set up a fund where not only the company provides money, also employees do that, and there's matching from the company and other people can collaborate. Without further introduction, we can move into toll roads, where we had growth in revenues and EBITDA in the consolidated numbers thanks to the managed lanes in Texas. And here, with the drop in traffic, the key is how heavy traffic is performing. It has more of a share of revenues, and it shows that our roads are located at the heart of the logistics flows in Dallas-Fort Worth. So a very good start in terms of financial performance. Of course, some tough months ahead, but traffic is starting to recover. Also, the liquidity there is abundant. We have more than 4 times debt service in terms of liquidity, and therefore we don't expect any financial stress there. The discussion will be timing and size of the dividends as the year goes on. Regarding the 407, yes, here we had a drop in revenues around 7% and slightly higher in EBITDA. And the key is going to be how traffic recovers. As we said, we are already seeing something of a better performance now that the economy is slowly reopening. And in terms of liquidity, again, excess liquidity to service debt, 1.5 billion versus 400 debt service this year. So dividends will depend on the evolution of COVID and operations along the year. If we move on to airports, here I would like to highlight the effort by Heathrow in cost reduction and reduction of CapEx, cost reduction higher than 30% and CapEx from 1.1 to 500. Most of these will flow in the remainder of the year, very little in this first quarter. Also, here the liquidity is very high with more than 3.2 billion pounds. Even without revenues, Heathrow could stand for 12 months or more. So in a very good situation, even though the outlook is uncertain regarding their traffic. AES is a similar situation, also with important cost and CapEx reductions, and already discussing with lenders preemptive waivers to have a solid structure for 2020 and beyond. In the terms of construction, impressive cash flow generation, mainly based in Poland, with an activity cash flow positive versus the negative last year, and with, as I said, limited impact in Spain, with some stoppage in some works and some delays. In general, in the rest of the countries, good activity, and also public clients looking forward to push for activity in this sector. The outlook is uncertain, but so far the year started in a good footing. Regarding services, I would like to highlight in Australia the approval from the antitrust, from the Competition Commission regarding the sale of broad spectrum. The only remaining approval is by the foreign investment approval, the FIRB, and once that's done, all condition precedents would be fulfilled, and we can close the deal. The rest of services, as I said, some impact in Spain, maybe around 7 billion euros due to COVID. In the UK, not really, and as I said, liquidity in most of the countries, not really that much in Spain, but better performance than last year and than expected by the services division so far. Okay, so regarding the net cash position, that is better, not only from that activity, cash flow was better, even better to cover for some share buyback of 47 million euros that started earlier than other years. Okay, so with this situation of better cash and better performance, and with all the care for the outlook of this macro situation, the board has decided to approve the first dividend on the back of the shareholders meeting, general shareholders meeting approval, and the second dividend will depend on the evolution of COVID and operations. So thanks for staying with us, and stay well.